Welcome to This Explainer. We're diving into something absolutely fascinating today, the invisible machinery that powers literally our entire financial lives. I mean, think about it. When you tap your phone to buy a coffee, or a massive corporation secures a $1 million credit line, you're interacting with decades of architectural evolution. We're going to trace that entire journey right now, starting from those early rigid mainframes all the way to the cutting-edge era of agentic AI. But as we'll quickly see, this isn't just a story about software upgrades. It's really the architectural construction of an anatomy of trust. Because every system, every cloud deployment, and every single line of code is designed to prove one crucial thing, that your money is safe, explainable, and accessible. All right, let's jump right into the structure for today. We're going to build the ultimate bank of the future step by step. We'll start with the core banking bedrock, look at escaping the physical branch, explore the composable architecture, enter artificial intelligence, and finally wrap up with the trust mandate. Part 1. The core banking bedrock. As consumers, we get to enjoy this incredibly seamless, frictionless illusion of simplicity on our smartphones. But right beneath that smooth interface, there's a massive, tightly structured world of complexity. So here is the absolute golden rule. You literally cannot slap advanced AI on top of a broken core. You need a centralized bedrock that ensures your money is actually your money. Before any of those slick apps even existed, banks had to make sure a withdrawal at an ATM instantly matched the ledger sitting back at the branch. That's the core banking system, or CBS. Heavyweight platforms like Finacle, Temenos Transact, Oracle FlexCube, TCS Bands, and FIS Profile, they act as this giant single source of truth. They're the standardized, highly scalable engines that keep the bank running and, crucially, compliant. And it's wild to think about the sheer breadth of what this engine handles. It's the starting point for every subsequent technological leap. In retail, it's doing the heavy lifting of opening your savings account and updating those ATM balances. For lending, it's calculating repayment schedules and actually posting your installments. Compliance teams rely on it entirely, completely, for transaction histories and audit trails. And over in the corporate world, it manages wildly complex overdrafts and relationship exposures. Make no mistake, if this single source of truth fails, the entire bank just stops. Moving on to part 2, escaping the physical branch. Because obviously, a modern bank can't just be an isolated core holding on to data. It has to branch out, turning that isolated system into a vast integrated ecosystem. Let's trace how this happened chronologically. Back in the 1970s, ATMs were a total game changer. They finally broke those rigid, localized banking hours. By the 90s, the internet moved us onto screens. And then the 2000s literally put the bank branch right into our pockets with mobile apps. But the 2020s, that's where things get truly wild, with embedded finance. This is the shift where banking stops being a destination and becomes invisible infrastructure. Through middleware and APIs, non-bank platforms, like your favorite ride-hailing or food delivery super apps, can suddenly offer wallets, instant refunds, and even lending. Meanwhile, the fully regulated bank is just quietly powering the whole shebang from the background. Now, there's a certain tasteful irony to global finance. Even with the best enterprise architecture in the world, systems still go down. It happens. So what actually happens if your bank's massive servers go completely offline on a busy Sunday morning? Well, thanks to resilience mechanisms like stand-in processing, or STIP, ecosystem-level continuity rules kick in. Card networks like Visa and MasterCard will temporarily step in and make authorization decisions for the bank based on predefined rules in your historical behavior. They essentially allow you to buy your groceries or gas, preventing everyday commerce from halting and protecting the broader economy from one bank's temporary glitch. It's brilliant. All right, part 3, the composable architecture. As our demands as customers accelerated, making constant changes to that giant monolithic core became incredibly risky. Banking desperately needed a modular refit. Just compare the old-school legacy monolithic approach with the modern composable architecture. Historically, every single time a bank wanted to update a mobile app, they risked breaking the entire core ledger because everything was so tightly coupled together. It was slow and it was ridiculously expensive. Today, instead of massive, risky core replacements, banks use a headless, API-first approach. They separate the customer experience totally from the back-end processing. This allows them to snap in specific microservices, literally like Lego blocks, just for onboarding or just for card controls, without ever touching that delicate legacy core. To power all these modular pieces, banks lean incredibly heavily on the cloud. But you have to understand, a bank's cloud strategy isn't like a typical tech startup's. They have to balance cost flexibility with severe, uncompromising regulatory and resilience requirements. Sure, a single public cloud is incredibly scalable, but banks must use hybrid models to avoid a catastrophic single point of failure. So, you might see customer-facing apps running on a public cloud, but highly sensitive core data sitting on a private or in-country cloud to meet strict data residency laws. And they use active-active deployments to guarantee instantaneous failover if one server site suddenly goes dark. But before we go installing the brain of our bank, we absolutely have to acknowledge the human delivery element. You can't just deploy code in a regulated bank the way you do in a dorm room startup. It requires a really specific hybrid model. Agile methods give teams the speed to design products and sprint through rapid feedback loops. But on the flip side, waterfall governance remains completely mandatory for things like regulatory approvals, risk controls, and overall compliance. And the crucial bridge between those two very different worlds? Business analysts. They're the ones translating high-level business strategy into auditable user stories, making sure this whole tech transformation is actually governed and compliant. Which brings us to part 4. Enter artificial intelligence. We are officially transitioning from basic digital automation to intelligent cognitive systems. But keep our foundational rule in mind. AI has to be safely integrated into the existing legacy estate. Think about this reality for a second. In a regulated bank, AI is not just a flashy tool or a basic chatbot, it actually becomes part of the control environment. The real hidden cost of AI only really shows up after a successful pilot. Suddenly, you need massive funding for model monitoring, explainability, data quality, and human oversight. Because if an AI model decides someone shouldn't get a mortgage, the bank has to be able to explain exactly why to a regulator. You have to actively, aggressively govern against biased or hallucinated financial decisions. And this takes us to a truly massive leap forward, agentic banking. We are moving past basic digital transformation right into intelligent transformation. In an AI-first stack, using secure data platforms and LLM orchestration, AI isn't just answering FAQs. We're talking about domain-specific agents that can retrieve complex information, recommend actions, and orchestrate massive workflows across end-to-end journeys. Crucially, the AI isn't replacing accountability. It's actively working alongside human employees in a highly collaborative operating model. This collaborative setup completely demystifies the whole AI task force idea. Take a credit agent, for example. It does the heavy data lifting, gathering policy rules and checking affordability in seconds. But then it hands that recommendation over to a human credit officer for the final policy approval. A fraud agent might group suspicious alerts and pull up a customer's history, but a human investigator actually handles the escalation and validation. The AI acts as an unbelievably smart co-pilot, but the human always retains the ultimate decision rights and the trust. Finally, part 5, the trust mandate. How do banking leaders actually govern this incredible evolution safely? There is a very specific, actionable blueprint for transformation managers, and it requires 5 distinct steps. First up, you have to assess the current technology baseline. You must know your legacy dependencies inside and out. Second, define a roadmap tied to measurable business outcomes. Please don't just buy tech because it's the trendy new thing. Third, modernize incrementally around the core to protect the stability of those critical operations we talked about. Fourth, strengthen your workload-specific cloud resilience. And finally, step 5, you absolutely must build AI governance and explainability before you try to scale. You have to define exactly what these AI agents can and cannot do without human approval. Because, honestly, if you ignore that blueprint, the risks are severe. If you treat this simply as a quick technology upgrade rather than a fundamental enterprise transformation, you risk creating immense execution complexity and architectural fragmentation. Moving to the cloud without rigorous disaster recovery, that just invites terrifying regulatory exposure. And scaling AI without rock-solid explainability, data quality, or clear agent accountability, you risk biased models and chaos. Ultimately, you risk the complete loss of your most vital, irreplaceable asset, your customers' confidence. So, I want to leave you with this final provocative thought. As financial services move out of the physical branch into our pockets and now become deeply embedded and practically invisible in our everyday lives, who really controls your trust? The most successful banks of the next decade are not just going to be the ones that deploy the flashiest new technology. The real winners will be those who intentionally design resilient, human-centered systems, balancing those modular architectures with strictly accountable AI to keep our financial world safe, explainable, and profoundly trustworthy. Thanks so much for exploring the evolution of banking systems with me today. Until next time, keep questioning the systems that power your world.